Good evening and welcome to our virtual home buying seminar. My name is Barbara Agan and I am the Director of Member Engagement and Education with Edify Credit Union. I'm here with Chris Papagni from Member First Mortgage. And Chris, go ahead and take it away.
Barbara, thank you very much. So welcome. My name is again Chris Papagni, and I am happy to be hosting this edition of Edify Credit Union and Member First Mortgages home buying seminar. This is essentially the home buyer seminar for the third quarter of 2025. As this is being presented, we are basically at the end of June. So, for all intents and purposes, we are talking about the third quarter as it relates to the home buying seminar that we are going to present this evening. I have been a mortgage loan originator for a little over 20 years. I'm currently licensed in 10 states total and have been originating mortgages exclusively for credit unions and their members for the better part of 2 decades. And so, with that being said, we would like to talk to you about the things that will hopefully help you qualify for a mortgage. And so, this first slide here, what we will cover, and really, spotlight is preparing to qualify for a home loan. We're also going to talk about the different loan product types that you can apply for with respect to a mortgage, and then also talk about the potential benefits of homeownership, which are many. So the key for, in my opinion, is for qualifying for a mortgage or successfully qualifying for a mortgage is being prepared. Preparation is key. Because as a very smart gentleman by the name of Ben Franklin once said, by failing to prepare, you are preparing to fail. So a little segue into what we're going to talk about as it relates to preparing to qualify for a mortgage loan. Now, the good news is every mortgage lender is going to look for the same three things from every borrower, regardless of what lender you are applying with, regardless of what type of mortgage you are applying for. Every lender is going to look for verifiable income, sufficient liquid assets to close, and credit scores. And we're going to go over each of those categories in great detail, starting with things that you can, as this process kicks off, what you want to do is start thinking about what documentation you're going to need. So we talk about gather documentation. When it comes to income, if you're a salaried employee, it's going to be pay stubs and W-2s. If you're someone who's self-employed, then it will be some, form of your uh, personal taxes and possibly business taxes, depending on if you're a LLC or a sole proprietor. I mean, if you had the opportunity, you could definitely review your credit in advance. I think most of us know or should have a decent idea of whether or not they have good credit or what they think their credit scores might be. Um, and of course, the most important part of the process is choosing a lender and completing the mortgage application, which is obviously par for the course. And then finally, selecting a realtor, right? So, realtors, most residential real estate purchase transactions are going to be facilitated, by a realtor. So, a realtor plays a very pivotal role in the home buying process. So basically, the buyer has their realtor, the seller has their realtor, and each realtor will represent their respective client's best interest. They work together on drawing up a contract for the purchase of the home, as well as ascertaining how the commissions are going to be paid and whatnot. So these are the people that borrowers, home buyers, and the lenders rely on to give us the information we need to do the mortgage that you're applying for, which is a contract spelling out the details of the transaction in question.
Yeah, another, benefit, if you go back in 1 second, just another benefit of working with a realtor is, first of all, whether you go on realtor.com or you go on, Zillow or whatever, you don't necessarily have the up-to-date information. And a good realtor will find out for you, what are your wants and your needs? What are you really looking for? And really only show you houses that are appropriate rather than, taking too much time showing you houses that are maybe, above your means, or, just not having, if you wanted a garage, doesn't come with a garage. Looking even at houses can get exhausting. So the better you are in tune with your realtor and they know what you're looking for, it'll make it a much more pleasant experience.
And Barbara's right. And what is that? What does that come back to? Preparation in terms of having an idea of what you want. And we're gonna touch on that, very shortly in the presentation. So basically, so from our perspective, we're talking about the borrowers, which will hopefully be some of you in the not so distant future. So the buying agent corresponds with the borrower, the home buyer, the person applying for the mortgage, and then the listing agent is going to be the person representing the seller in the transaction. So there you have the relationship between the respective agents, and they will work diligently to help us be able to, get your loan processed, approved, and closed as quickly as possible. So basically, they work on the contract. They hammer out all the details as to what the terms are, who's paying the commissions, what the closing date is, so on and so forth. Very common, um, very common, pretty much standard operating procedure when you're buying a home. Some homes you can buy what we say for sale by owner, where there's no realtor involved, but that's very much more the exception and not the rule. And most transactions, again, will involve the realtors that we have just been talking about. And so we move on to the next concept, which is very important: wants versus needs in your budget, right? I mean, you're buying a house, if you're getting a mortgage, depending on what that dollar amount is and what that monthly payment's going to be, it's certainly going to change the landscape of your expenses. Remember, mortgage lenders are qualifying based on gross income, which is before tax. And, nobody is going to have their finger on the pulse of your expenses more than you, right? So, when you're thinking about buying a home, you're thinking about all the additional expenses that come with that. And then, correlate that with the things that, you'll need, which we all know you'll need: utilities, electricity, and food and sustenance, versus things that you may want, such as better landscaping or a pool, which may still be in the future, but may not be something that you would want to do right out of the gate. So very important to sit down and again, prepare for what your new expenses are going to look like after you buy a home versus before buying your home. And so I get this question. I take phone calls every day where people call up and say, I'm ready to buy a home. I'd like to get pre-qualified. What do I do? And literally, these are a couple of the questions that I ask, again, talking about preparation. What type of home am I interested in? Ask yourself this question: what type of home am I interested in, and where would I like to purchase that home? Speaking specifically of the county and the city. The type of home: single family dwelling, townhouse, condominium, multifamily. And these are the things you want to ask yourself, because everybody's going to have, different needs based on their situation. You could have a young guy, a young gal's looking to buy their first home. They're single. Maybe they just need, a one-bedroom condominium. Perhaps you have a married couple that is looking for a starter home. Maybe start the family there and then move on to greener pastures. So they just need a little single-family home. You have somebody that maybe needs a two-family home, that wants to move their loved one into the apartment of the two-family home they're buying. So that is part of this process: assessing the type of home that you would like to purchase, and some of the features as well. Do you need a minimum amount of square footage? Do you need a finished basement? Does it have to be a ranch? Can it be a split level? Do you absolutely not want a crawl space? No crawl space for me. That's because I have one and I hate it. But you want to think about the type of home that you want to buy, and then of course where you want to buy it: county, city, as we start to form the idea of what it is that you're going to try and buy. And Barbara mentioned it before, Zillow, Redfin, Realtor, these are terrific resources to sort of get a sense as to what might be out there. They're no substitute for an actual realtor that you'll presumably eventually work with, but you could use these resources, and they have filters where you can go and say, okay, I am looking for a minimum 4 bedroom, 2 bathroom, split level with a minimum of 1,800 square feet and a 2 car garage or whatever in Bergen County. And then you'll be able to filter through some of the properties that meet that criteria to give you a taste or an idea of what a price point might be. And then from there, you would have a further conversation with a realtor. But part of the mortgage process is having an idea of what you want to buy and where you want to buy it. A very, very important part that is going to help everybody, the realtors, your lender, match you with the right property. And so as we move on to the next criteria that lenders look for, probably the most important one is credit. So credit scores. I can tell you probably the most important criteria, despite the fact all the criteria is equal that a lender is looking for. The one that holds the greatest weight is credit. And so what we've done here is we've broken out how the CRAs, the credit reporting agencies, calculate your credit scores based on specifically for mortgages, because there are different credit reports for non-mortgage loans versus mortgage loans. So as we see here, 35%, so a little over a third of the credit scores are calculated on your payment history, which is obviously making your payments on time and having a history of making your payments on time on revolving debt or whatever debt it might be. Next, we have capacity. This is really important. Capacity means, what you owe versus the limit, right? And they call that also utilization. So, for example, if you had a $10,000, Visa card that had a $9,000 balance, you now have a 90% utilization. Ideally, you'd like to have utilization, maybe no greater than say 30 or 40%. You'd want to keep the utilization as low as possible, as best as possible within your control. And then we have, credit history. Credit history is very important. How long have you used credit? More time gives a better indicator of how you pay. So you want to, establish a footprint credit wise and build up that credit history, because it's could be the difference between qualifying for a mortgage and not qualifying for a mortgage, or qualifying for a mortgage with a higher rate because the credit scores are not very good. So I can't stress enough the importance of keeping your credit scores as high as possible. Inquiries, 10%. You don't want to be applying all over town, for lack of a better term. That kind of indicates, that maybe it's not working out everywhere for whatever reason, and you're applying everywhere just to try and get qualified. So you want to keep your inquiries to a minimum if you can. And the type of credit that's being used, revolving and installment, are typically your two main credit categories. Revolving is basically a credit card. Installment would be a fixed personal loan or an automobile loan, things of that nature. So this is how the credit scores are calculated. It's very important to keep your credit in good standing. And obviously, if your credit maybe is in some disrepair or marginal for whatever reason, you're going to want to look to get those credit scores improved before trying to apply for a mortgage. So we're going to move on to the second criteria that every lender looks for, which is employment and verifiable income. So every lender is going to look for some of the things on this next slide. Minimum 2-year history in a similar line of work, which is not technically necessary per se, but as long as most lenders are looking for a 24-month uninterrupted history of employment. It doesn't necessarily have to be 2 calendar years, But within that 24 months, someone could have switched employers, whether in the same line of work or not. If there are employment gaps, those would need to be explained. So if in the last 24 months, somebody was not working for, say, 4 or 5 months out of that time frame, uh, such gaps would need to be addressed. If they, if that's the case, lender is going to verify employment. So for salaried employees, a lender will do what's called a written verification of employment, which is basically a document that essentially says exactly what it says. It's your employer verifying your employment. And if you're self-employed, that goes without saying. That's going to be always getting tax returns in some shape, way, or form. Whether it's 2 years worth or a year's worth, depends on how long you've been self-employed. If you're self-employed over 5 years, you're only required to submit the most recent year's tax returns. Under 5 years, you will then be required to submit the last 2 years federal tax returns, all pages and all schedules. So now we talk about income. We talk about income, and we talk about the most common sources of income with qualifying for a mortgage, which are going to be W-2 earnings for those of us who are salaried employees. Child support and alimony can be used as income, qualifying income, based on meeting certain criteria. Retirement and pension income, obviously, a lot of people, once they retire, they're going to receive, some sort of pension, presumably, as well as Social Security income. So these four categories represent, your most common sources of income. And I would throw in, obviously, with the self-employed borrower, it's whatever the income will be that is being reported on the business tax returns. And so the income plays into a concept called ability to repay. So ability to repay is basically taking all of your liabilities plus the mortgage payment that you're trying to qualify for and dividing that into your gross monthly income to come up with these ratios that you see here on the next slide. There are typically two ratios that lenders will focus on, a housing ratio and a total debt ratio. So for example, if you had a mortgage payment that was going to be $2,000 and your income, your monthly income was $6,000, 2,000 into 6,000, that's 33%. That would be perfectly fine. Despite the fact that it says 30% on the slide, 33% would be fine. And then the total debt ratio is taking the prospective new mortgage and adding whatever other debts you have on your credit report, credit cards, auto loans, student loans, things of that ilk, and then dividing that into your monthly income. Total debt ratio, or what I sometimes like to refer to as your total obligations to income ratio, which is literally all your obligations into your income. That ratio typically tops out at 43%. Some people can get qualified in some cases up to as high as a 50% total debt ratio, right? So, I mean, if your total debts were $3,000 and you made, $6,000 a month in verifiable income, that's a 50% ratio, total debt ratio. And some people can qualify with a ratio that high, but generally speaking, you want to stay within the ranges that you see here on the slide as far as the general ratio guidelines are concerned. So now we're going to move on to the next criteria. We've talked about credit, we've talked about income, and now we're going to talk about sufficient liquid assets to close. All loans require a down payment of some shape, in some shape, way, or form, except for two specific government loans that we will chat about very shortly. But before we do that, we're going to talk about what the common sources of funds to close come from. Liquid asset accounts, very self-explanatory, right? Checking, savings, money market, things that can be easily liquidated, like certificates of deposit, stocks, bonds, anything that can be liquidated into cash would be a liquid asset. It may not be liquid at the moment that you're, depending on what it is, such as a stock, for example, but you could turn around, sell the stock, deposit the proceeds into your checking account, that would count as a liquid asset. You could also get a gift from a relative, specifically a blood relative. You can receive a cash gift from an immediate blood relative towards the purchase of a home, whether that be for down payment or closing costs or a combination of both. And then finally, borrowing against an asset. Specifically, we're talking about a 401k. Some, people that have a substantial 401k balance may be able to borrow against it and use those funds as a source for down payment and closing costs on a home purchase. So those are your three most common sources of funds. And when we talk about sources of funds, what is that going towards? It's going towards the down payment and your closing costs. On the slide we have here, it talks about essentially the total amount of cash that you may need at closing. I say may because reserves are not always required. Reserves are, basically showing a certain amount of money left after your down payment and your closing costs and your prepaids have been satisfied, I should say. So your down payment, that's just whatever the down payment's going to be on the home. You're buying a home for $500,000. You're making a 20% down payment, so your down payment's $100,000. Your closing costs will be whatever they'll be, relative to if you're using a title company or a real estate attorney or both. When we talk about prepaids means establishing escrow accounts for taxes and insurance. So certain monies would be collected from you at closing to establish the funding of the escrow accounts for property taxes and homeowners insurance, as those are paid by your lender vis-a-vis the servicing of your loan. If you do a loan with us here at Member First Mortgage and Edify Credit Union, your loan will always be serviced by Member First Mortgage and never be sold to another entity. And again, reserves are only required if necessary. And on most purchase transactions, reserves are very, very atypical, but nonetheless a category that you, for the right scenario, that is, more money that you would have to demonstrate vis-a-vis a eligible liquid asset. All right, so we'll move on and talk about the types of loan products. And so we talked about before, there are a couple of loans that come with a no down payment. We're going to talk about those two loans very shortly here. But starting with the standard conventional loans, those are loans that are underwritten to the guidelines of either Freddie Mac or Fannie Mae. There are some products, conventional loan products, for qualified borrowers where the down payment can be as little as 3% of the purchase price. We also have high balance loans, which are what we call also super conforming loans. And these are loans that fall within a certain loan limit based on the county that the property is located in. We can get into that, a little bit later. In fact, we'll get into it right now. So that has to tie that the previous slide ties into what we're looking at now, which is what we call standard conventional loan guidelines. So the Federal Housing Finance Agency sets a limit each year. That limit in 2025 is $806,000. And there are certain counties in every state in the country that will have what they call high cost areas or super conforming areas. So for example, in one county in New Jersey, the county limit could be the 806, right? In another county, the county limit could be $1.2 million. So that is what we mean by a high cost area. So for example, there are, some counties, I believe Morris County, I believe Essex County, those would be super conforming areas in the state of New Jersey. To give you the distinction between super conforming and conforming. When you're buying a home and you're making a down payment, there is no private mortgage insurance required with a down payment of 20% or more. Private mortgage insurance is required anytime a down payment is less than 20%. Private mortgage insurance is insurance that protects the lender from potential default. So the idea is the less money you put down, the greater the perceived risk hence the need for the private mortgage insurance. And I mean, a conventional mortgage, that's the mortgage that everybody is going to try and qualify for if they can, because that really is the superior, product across the landscape of the products that are being offered. And so, with that said, we're going to talk about some of the other products and the advantages that they have for each product. But typically, people are going to try first and foremost to get qualified for a conventional mortgage, and a conventional mortgage can be applicable on a primary residence, vacation homes, investment properties. Again, for the sake of our discussion, we're going to focus primarily on a primary residence, either single family, condominium, townhouse, or multifamily. So the government has a couple of actually has three mortgages that we currently offer. The most popular one is the FHA mortgage. An FHA mortgage is really suitable, for a potential home buyer that maybe has marginal credit and doesn't have a lot of money to put towards a transaction, a purchase transaction. As you can see, the minimum down payment requirement is only 3.5% of the purchase price, which is quite low. And some FHA lenders can go as low as 580 on the minimum credit score. And of course, there is what we call mortgage insurance premium. That is compulsory on each and every FHA loan, and that is equal to 1.75% of the loan amount. Again, gift money is acceptable from a blood relative. And basically, again, this is a good loan or a potential good option for someone that maybe has, is credit challenged and doesn't have a lot of funds to work with. FHA is a lot more flexible with the credit score as well as with the minimum down payment of 3.5%. The next government loans, so the next two that we're going to talk about will cover the options where there is no down payment. So a USDA loan is a loan for a property that is in an eligible USDA rural area. I mean, there are, certainly some counties in New Jersey where they probably and most definitely have properties that would be USDA rural area eligible. And that's kind of the first, first hurdle that needs to be cleared to find out if the property that you're interested in is indeed in the federal USDA rural area list. If it is, then there is no, it's 100% financing, as the first bullet point says. You could buy the house for $200,000 and borrow $200,000. It's available for both purchases and the interest rate reduction refinance loans, which, again, for the sake of our seminar or our webinar, we're focusing, really from the purchase perspective, not so much the refinance perspective. Again, minimum credit score 640, which is not bad. 1 to 4 family residential. You have your 1% upfront fee, primary residence only, and of course the main takeaway, probably the most important bullet point, is being on the USDA rural area eligibility list. And that brings us to the final government loan, which is the VA loan. So this is a loan where if you are an eligible veteran, again, no down payment required. An eligible veteran can purchase a home for $500,000 and get a mortgage for $500,000. Eligible veterans will have to, of course, present to what's called the certificate of eligibility, which is basically the gateway for being able to get a VA loan. The funding fee can be rolled in to the loan for the first time. That is the funding fee that is compulsory with VA loans. No private mortgage insurance, so there's no down payment, so there's no private mortgage insurance. Again, a very flexible credit score of 580 and, of course, primary residence only. So those are your three government loans: the VA, the USDA, and the FHA. And so what we'd like to talk about now is, avoiding mortgage pitfalls. So in preparing, to apply for a mortgage, Beyond everything that we've talked about, these are a couple of pointers you'll definitely want to keep in mind as you prepare to apply for and qualify for your mortgage. So, and again, this basically says, you know, one little innocuous action that you don't think could be an issue can sometimes be an issue. So, what am I referring to? Credit and new debt. Ideally, if you're in the middle of a mortgage transaction, whether your credit score is 800 or whether your credit score is 680, you're really going to want to, you know, try and stand down on opening any new credit, not because you may not qualify for it and it may not have any effect on your mortgage. However, what will happen is if you do have no any inquiries or any new credit open, the lender is going to ask for the details of that credit and if a certain inquiry did result in new credit. So it kind of opens a can of worms that if you could stand down on and do wait till after the closing of your home and your mortgage, that would probably be the better approach. You can go out and get 5 new loans during the processing of your mortgage, and you will then have to talk about those 5 loans before closing. So you would really want to try and defer any new credit or new debt if possible. And things like modifying the terms of a loan by entering into a forbearance, right? If somehow you got jammed up on a student loan or an automobile loan and they let you skip a couple of payments, that's something that you definitely do not want to get involved with because I was saying before the importance of credit. Rates and programs can definitely be affected by your credit score. I mean, essentially can mean the difference between qualifying and not qualifying. And I've seen it happen more times than I can imagine by having marginal credit scores. So now we move on to employment changes. You can definitely change employers even during the transaction. However, you would have to be on that new job for at least a month before you can close. Okay. And I would say if you apply for a mortgage and that a change in employment is imminent, like you're going to be leaving your job to start a new job before your loan is going to close, you most definitely want to share that with your lender swiftly. Because there could be, ramifications by not advising the lender in a timely fashion or advising the lender at all. And I've seen both scenarios happen and both outcomes were not very good. So, I mean, ideally, you'd love to take a new position and then be there and then apply for the mortgage. But if there is a job change during the processing of a mortgage application, you're going to want to share that with your lender sooner rather than later. So now we're going to talk about a concept called large deposits. A lot of times people will deposit, cash into an account that isn't seasoned, meaning it hasn't been on deposit for at least 2 months. So somebody gives you a mortgage or a bank statement that says, $10 balance on June 1st, and then there's a $45,000 deposit on June 10th, and that was a $45,000 cash deposit. That's no good. That cannot be done. So what you would want to do ideally is not have any deposits that would be north of 50% of your verified gross monthly income. So that's a little inside hack. If your gross monthly income is $6,000, you can deposit up to $3,000 in cash and not need to source. That is the term we use, source where those funds came from. And I would say, to the best of your ability, if you have several accounts that you would plan on using for a mortgage and a home purchase transaction, at some point you would probably want to try and concentrate that all in one account if possible. It'll make things infinitely easier for you and your lender, because if you do that and you do that well enough in advance, you'll only have to give one bank statement or maybe 2 from one account instead of 1 or 2 bank statements from 4 different accounts, because they're coming from 4 different sources. So just just a tip along those lines when it comes to quantifying and getting your assets situated. And when it comes to gifts, yes, the gifts are very important because a gift has to be from a blood relative that actually has been expanded to include fiancés, people that are obviously going to get married, but they're not actually married yet. So fiancés as well as immediate blood relatives. You want to make sure you run that past your loan officer to make sure your donor is eligible. Cash gifts are never acceptable. There's no cash in mortgages. Like there's no crying in baseball from a league of their own. There's no cash in mortgages unless you're making a cash deposit less than half of your verified gross monthly income. So many gifts can be wired to the title company at settlement. They can be given directly to the borrower prior to closing via check or anything other than cash. And all donors, and this is standard operating procedure. There's a gift form, a gift letter. The donor signs it. The borrower signs it. Again, standard operating procedure that basically spells out the terms of the gift, how much it is, who it's coming from, the relationship between the donor and the borrower. And so all this brings us to the idea of getting pre-qualified. So hopefully now armed with some of the knowledge that we've talked about, you will be in a position to do a mortgage pre-qualification and hopefully know just about exactly what you'll need to do in the run up to that application. Because the idea behind this seminar is to put you in a position to qualify and to give you the information that you will want to need to give to the lender. This way you are prepared to do that ahead of time and you have an understanding of how this works. I can tell you that for sure you will want to, if this is something you're serious about, sit down and think about all the things we've talked about. What do you want to buy? Where do you want to buy it? Wants versus needs. How much money can you bring to a transaction? These are the things you want to start thinking about. And doing a pre-qualification is compulsory. No realtor will take your house hunting unless you have been at minimum pre-qualified. Pre-qualifications with us are good for 90 days, so it's a nice wide window for you to get out there and go house hunting. And obviously, once you make application or you initiate an application with a lender, you're going to want to stay in touch with your MC mortgage consultant or MLO mortgage loan originator, whichever you prefer. And it really, it should be more so your loan officer keeping it, in touch with you. Because once you're pre-qualified, the next step is yours in terms of coming back to the lender and then, with a contract after you've been successfully pre-approved, hopefully with some help from tonight's webinar. And potential benefits of home ownership, I think, are pretty self-explanatory. You will be able to claim your interest paid on the mortgage that you have. Obviously, you'll talk to a certified public accountant for specifics on how that works. And leveraging equity. I mean, a home is an asset, and it's an asset that's funded by credit, which is done all over the world with all different sorts of assets. But your asset is going to hopefully increase in value. So when we say leveraging equity, if you needed to borrow against your home for whatever reasons, home improvements, college education, down payment, you might be able to do that. I mean, if, for example, you have a mortgage of $200,000 and your home is worth, $600,000, then you have 67% equity that you can leverage in exchange literally for cash to do things like home improvements, college education, debt consolidation, any number of, reasons. And then of course you're building wealth. Hopefully the house that you're buying continues to appreciate over time. You could build, generational wealth. If you have a big family and it's a great house, perhaps it gets, passed down to a child or a grandchild, and something that, stays in the family. It's sort of like a family heirloom. So you're building, not only actual net worth by the increase in the asset, but maybe building, for something bigger and better for a couple of generations down the line. And so with that said, that concludes the presentation for our third quarter home buyers seminar. Again, my name is Chris Papagni. My information appears on the screen. I will, at this point, apologize for any stuttering or stammering that I may have done throughout the presentation. It was the first dry run, but I think it was a good one. And I hope that you find the information presented here tonight helpful in your quest to qualify for a mortgage and buy a home. And please, if you have any mortgage questions, do not hesitate to contact me either electronically or by phone. All the information is right there on your screen. Thank you so much for joining us.